and welcome to Sectors Up Close. I'm Elena Casas. Our focus today is on financials and our guest is Mike Hanson, Senior Vice President of Research at Fisher Investments. Financial stocks have had quite a wobble this past month after surging in the first 5 months of the year. The MSCI World Financials Index has fallen 6.5% since its peak on June the 4th. It has managed to hold on to gains of about 17% so far in 2021. There are several factors at play. The macroeconomic backdrop remains positive as many economies still have a long way to go before normalising. Payments have also recovered, while banks' monopoly on them has been significantly weakened by fintech startups such as Square. But the main stress on bank earnings is low interest rates. A plunge in long-term bond yields means that if short-term costs go up in 2 or 3 years, banks may end up paying more for capital on deposits than they're making in loans. That clouds their long-term outlook. Banks yearning for higher yields was notably evidenced this week by the announcement by Britain's Lloyds banking group that it's entering the housing rental market. So, what is the outlook for the sector? Well, for more on this, I'm now joined by Fisher Investments' Mike Hanson. Hello Mike, thanks for joining us. So, given the gains we've already seen in the sector this year and the potential end to the reflation trade, which of course we're seeing today, what's your outlook?
Well, Elena, I think you've said it exactly right. Financials, and in particular the big banks, have acted as sort of a proxy for this reopening cyclical trade. And just as you said, they came out of the gate very well in the beginning of this year, but in the last several months have actually stumbled a bit as growth stocks have retaken the lead. I think that the issues that investors should think of, especially with banks, is that they have stable balance sheets. Profitability is going to be the issue. And just as you mentioned, I think one of the key things to look at is global credit and loan activity. It's slow all around the world, whether you go from China to US to Europe, and I think that's very much a feature of the tight yield curves and low absolute rates that banks are facing. They're just not making a lot of profits.
But the elephant in the room here is quantitative easing, isn't it? And the potential for a taper tantrum once the Fed starts to rein that in. So what's the risk?
Well, Elena, I have to tell you, I feel very strongly that fears about the taper tantrum are just simply false fears. The truth about the monetary world across the world, wherever you go, is that money is very accommodative today. A small change in perhaps asset purchases or perhaps a couple of interest rate hikes does not fundamentally change how most of the world will go. We are in an accommodative world. I think that's the most important thing first. Secondly, we do have a history of looking at some of these taper tantrum ideas. If you go back 10 years ago, was sort of the first iteration of that. Yes, there was volatility. Yes, there was concern. There was also a sovereign debt crisis going on in Europe, which I think contributed. But within 6 to 12 months, the world moved on. In fact, interest rates continued on lower as the bull market continued. I see no reason why that wouldn't happen again this time around.
Is there more opportunity in Europe now then than in the US?
Well, you want to be very careful. I think for international investors need to think through what country they're looking at for each bank, because banks tend to be fairly well correlated with the country they operate in terms of their equity prices. Europe, though, in particular, tends to have what I would call a little more traditional banking, a focus on that, where they really do make money on the difference between interest rates and their ability to make loans and credit. In the U.S., it's a little bit different. It's a little more broad. There are things like investment banking and brokerage services, which are a little more available, particularly to the equity markets. And I think that's a good place for investors, relatively speaking. IPOs, SPACs, but even more broadly, investors are demanding all sorts of types of products today, and actually sophisticated investment products. All those are fee-based. Banks can make quite a lot of money on that, particularly in the United States.
So what should investors be looking to buy in the financial stock space?
Well, in my opinion, we're more like late cycle than we are early cycle, which speaks towards financials not doing as well as the broader market, perhaps with some bursts of outperformance. I think that's pretty much what we've seen so far. But I would advise investors to not be lured by cheap valuations. There's a lot of cheap bank valuations today, but very often things are cheap for a reason, and those low valuations have been true for a while. Instead, I would think a little bit differently about the sector. One of the most vibrant areas is transactions and payment systems of all kinds. That's growing around the world in a variety of ways. Companies that participate in that will see tremendous revenue growth, tremendous churn. They should see above GDP growth there. I would also argue that, it's a little more narrow, but data providers, financial services data providers, is a really hot growing area. Huge demand for data services, high margins, people willing to pay. It's a big growth area. I think investors should probably look there as well.
Thanks so much for that. That was Mike Hanson of Fisher Investments, Senior Vice President of Research. Well, before I go, here are some of the top stories in the sector. Fintech companies based in London raised a record amount of venture capital in the first 6 months of the year. This, according to new research by Dealroom and agency London and Partners. Investors poured $5.3 billion into London fintech startups in the first half, more than double the same period in 2020. Globally, it ranks second behind San Francisco and slightly ahead of New York, and comes despite the UK's exit from the European Union at the beginning of the year. US Senator Elizabeth Warren has warned of the growing risks cryptocurrencies pose to consumers and financial markets. The Democrat is the current chair of the US Senate Banking Committee. She raised her concerns about cryptocurrencies in a letter to SEC Chair Gary Gensler, in which she requested answers from Gensler by the 28th of July on the SEC's authority to protect consumers investing in cryptocurrencies and to determine what future congressional action may be needed. Her actions mimic warnings from Federal Reserve Chairman Jerome Powell and Treasury Secretary Janet Yellen that greater regulation may be needed. And China's central bank said anti-monopoly measures applied to Alibaba's Ant Group will also be imposed on other payment service providers. China suspended the $37 billion listing of Ant Group last November on concerns banks were using third-party payments platforms for underwriting loans. In April, regulators imposed a sweeping restructuring of the fintech giant, forcing it to turn itself into a financial holding company and cut links with its payment app. China's central bank said, quote, monopolistic behaviour exists in other institutions, and said measures against them would be revealed soon. And that's your roundup of the financial sector. I'm Elena Casas, and this is Reuters.